You know that sick feeling when you exit a trade early, watch it run another 20% without you, and then beat yourself up for the rest of the week? Yeah, I used to do that too. But here's what nobody tells you. Those early exits you think are costing you money might actually be the exact reason some traders consistently outperform the market, while others blow up their accounts. What if I told you that the traders making the most money aren't the ones holding until the absolute peak, but the ones comfortable walking away with good enough? Stick around, because what I'm about to share completely changed how I think about exits, and it might just save your trading account. Let me take you back to a moment that shifted everything for me. I was holding a position in a tech stock that had already given me a solid 18% gain in 3 weeks. My original target was 20%. I was so close. Just 2 more percentage points, and I would hit that perfect number I had written in my trading journal. But something felt off. The momentum was weakening, volume was declining, and there was this nagging voice in my head saying, "Take the profit now." I ignored it. Because that's what we're taught, right? Stick to your plan. Don't let emotions dictate your trades. 2 days later, the stock gapped down 7% on earnings, and I watched my 18% gain turn into an 11% gain in a matter of hours. I eventually exited at 9%, less than half of what I could have locked in. That experience taught me something crucial. Trading isn't just about the perfect entry or the perfect exit. It's about understanding the psychology behind why we hold, why we exit, and how our brains often work against our best interests. The conventional wisdom in trading says you should always have a predetermined exit strategy. Set your target, set your stop loss, and execute mechanically without emotion. And while there's truth to this approach, it misses something fundamental about how markets actually move and how human psychology intersects with profit-taking. Here's the reality that most trading educators won't admit. Markets are fractal and probabilistic. That means there's no such thing as a perfect exit. Every single time you close a position, you're making a decision under uncertainty. The stock could go higher, it could reverse, or it could chop sideways for weeks. You simply don't know. And because you don't know, holding out for perfection is a fool's errand. Let's talk about something called the disposition effect. This is one of the most well-documented biases in behavioral finance. Research shows that traders have a strong tendency to sell winning positions too early and hold losing positions too long. At first glance, this seems like it contradicts what I'm saying about early exits being beneficial. But there's a critical distinction here. The disposition effect describes emotional, reactive exits driven by fear or the need for immediate gratification. What I'm talking about is strategic, intentional profit-taking based on probabilistic thinking and risk management. These are completely different animals. When you understand the difference, you realize that exiting early isn't about being scared or impatient. It's about recognizing that capturing a solid profit repeatedly is mathematically superior to occasionally catching the perfect exit while giving back gains the rest of the time. Let me break down the math in a way that makes this crystal clear. Imagine you take 10 trades. In scenario 1, you try to maximize every single trade, holding for the absolute peak. Maybe you nail it twice, getting 30% gains. But on the other 8 trades, you either give back significant gains or hit your stop loss because you held too long through reversals. Your average might be something like 8% per trade. Now scenario 2. You take profits earlier, maybe at 15 or 18% instead of waiting for 30. You're less likely to give back major gains because you're exiting while momentum is still in your favor. Even if you occasionally leave money on the table, your consistency improves dramatically. You might average 12% per trade across those same 10 positions. Which scenario makes you more money? The consistent one, every single time. This is where trading psychology gets really interesting. Our brains are wired to seek maximum rewards, not optimal rewards. There's a huge difference. Maximum reward means holding until the very top, which is essentially impossible to do consistently. Optimal reward means taking profits at a point where the probability of further gains is declining relative to the risk of reversal. Professional traders understand this distinction deeply. They're not trying to be heroes. They're not trying to squeeze every last penny out of every trade. They're trying to build a system that generates consistent, repeatable profits over hundreds or thousands of trades. One of the most successful day traders I ever met told me something that sounded crazy at first. He said his goal was never to maximize individual trades, but to minimize regret across his entire portfolio. Think about what that means. He wasn't trying to catch tops or bottoms. He was trying to exit at points where, regardless of what happened next, he could feel good about the decision based on the information available at that moment. This mindset shift is absolutely massive. When you stop measuring success by whether the stock continued higher after you sold, and start measuring it by whether you made a good decision with the information you had, everything changes. You're no longer torturing yourself with hindsight bias. You're evaluating your process, not your outcomes. Let's talk about another psychological factor: the pain of regret versus the pain of missed opportunity. Studies in behavioral economics show that the pain of a loss is roughly twice as powerful as the pleasure of an equivalent gain. But here's the twist. Watching a stock run without you after you've exited creates a unique type of pain that isn't quite a loss but feels like one. This phantom pain keeps traders in positions too long. They're so afraid of that regret, that feeling of watching profits evaporate, that they hold past the point of rational risk management. They convince themselves they're being disciplined, but they're actually being controlled by fear of a pain that hasn't even happened yet. Early exits protect you from this psychological trap. When you take profits while a position still has momentum, you're making an active choice rather than a reactive one. You're in control. And that sense of control, that feeling of agency in your trading decisions, compounds into better overall decision-making across your entire portfolio. There's also something called the house money effect that's worth understanding. After you've made some profit on a trade, your brain starts treating those gains differently than your original capital. It feels like house money, like you're playing with the market's cash instead of your own. This leads to excessive risk-taking and holding positions too long because, hey, you're already up, right? Wrong, every dollar in your account is your dollar, whether it came from your initial deposit or from trading gains. Treating unrealized profits as less valuable than cash is a cognitive error that costs traders enormous amounts of money. Early exits help counteract this bias by converting those unrealized gains into actual cash before your brain tricks you into giving them back. Now let's address the elephant in the room. What about those times when you exit early and the stock absolutely rips higher without you? What about when you sell at 18% and it goes to 40% the next month? Doesn't that prove you should have held longer? No, it doesn't. And here's why. You're evaluating one outcome in isolation instead of looking at your results over time. Yes, sometimes you'll exit early and leave money on the table. But other times, you'll exit early and save yourself from a brutal reversal. The question isn't whether early exits sometimes cost you money. The question is whether they make you more money overall when you look at dozens or hundreds of trades. Every piece of research on trading performance suggests they do. Traders who practice disciplined profit-taking, even if it means occasionally exiting before the top, dramatically outperform traders who constantly chase maximum gains. There's a concept in trading called profit fade, and it's absolutely killer. This is when you have a nice gain, you get greedy and hold for more, and then the stock reverses, eating into your profits. Maybe you break even, maybe you even take a loss. But the psychological damage of watching a winner turn into a loser is enormous. It shakes your confidence, makes you question your strategy, and often leads to revenge trading or other destructive behaviors. Early exits are your defense against profit fade. They're how you protect not just your capital, but your mental capital. Because trading psychology isn't just about managing fear and greed in the moment. It's about building a track record of decisions that reinforce positive behaviors and good habits. Here's something else most traders don't think about: the opportunity cost of staying in a position. Every dollar you have tied up in an existing trade is a dollar you can't deploy into a new opportunity. If you're sitting on a solid gain but holding out for perfection, you might be missing 3 other trades with better risk-reward profiles. Early exits free up capital and mental bandwidth for new opportunities. The best traders I know think in terms of capital efficiency, not just profit per trade. They'd rather make 12% in 2 weeks and redeploy that capital than make 20% in 3 months. Because over the course of a year, the trader who consistently captures smaller gains and reinvests is going to crush the trader who holds forever waiting for home runs. Let's get practical for a moment. How do you actually implement this early exit philosophy without it just being random emotional selling? You need a framework, and here's one that works. First, define what early actually means for your strategy. If your typical targets are 20 to 25%, early might mean 15 to 18%. If you're a day trader targeting 2% moves, early might be 1.4%. Second, identify the conditions that justify an early exit. This might include weakening momentum, decreased volume, approaching resistance levels, or simply the trade taking longer than expected to develop. The key is having objective criteria, not just exiting because you feel like it. Third, use a scale-out approach. Instead of exiting your entire position early, take partial profits. Sell half or a third of your position to lock in gains while leaving some room to participate if the move continues. This gives you the best of both worlds. You've secured profit, reducing stress and protecting against reversal, but you haven't completely eliminated your upside potential. Fourth, track your exits and analyze them over time. Keep a detailed journal of when you exit, why you exit, and what happens afterward. Over months and years, patterns will emerge. You'll see that your early exits, on average, probably saved you from numerous profit fades while only occasionally costing you additional upside. The psychological benefit of having this data cannot be overstated. When you exit early and watch a stock run, you can look at your journal and remind yourself that based on your historical data, you made the right process decision. This keeps you from second-guessing yourself into paralysis. Here's the ultimate truth about exiting early. It's not really about the specific exit point at all. It's about building a relationship with uncertainty that allows you to trade consistently over years and decades. Markets are uncertain. Outcomes are probabilistic. The trader who accepts this and makes peace with good enough will always outperform the trader chasing perfection and certainty. Exiting early is an act of emotional maturity in trading. It says I'm comfortable with ambiguity. I don't need to know what happens next. I made a good decision based on probabilities, I captured a solid profit, and I'm moving on to the next opportunity. That mindset, that psychological framework, is worth more than any technical indicator or chart pattern you could ever learn. So the next time you're sitting on a nice gain, and that voice in your head says, "Take it now," listen to it. Don't let the fear of missing out override your rational assessment of risk and reward. Lock in that profit, pat yourself on the back for a successful trade, and start looking for the next opportunity. Because in the end, trading isn't about being right about where the market goes. It's about making enough good decisions that your account grows consistently over time. And early exits are one of the most powerful tools you have to make that happen.